All right, we're going to do it. Good afternoon. Thank you so much on behalf of FlowerHire Senior Advisors and the entire FlowerHire team. Really, really glad to have all of you here. And of course, my cell phone goes off as soon as we get started. So we're talking about equity compensation. It is a very hot topic, no pun intended, especially given the performance of cannabis stocks over the last several quarters. But the reality is that what we realized in meeting with executives like we do every day is that irrespective of market conditions, there just tends to be just a great mass misunderstanding around what are these stock packages, what do they mean, what are the various elements, and how do we go about thinking about their worth, right? Both in market time today and the future. So that was why we thought it would be good to get together and start this conversation. And then at the same time, we're also actively involved in talking with HR leaders and CEOs and founders. And what we realize is that similarly, many of those folks are really not, they just don't have a ton of clarity, I would say, Jason, I think I'm using the right language,
Yep.
about how to devise a stock program that's actually going to be really compelling and going to help build an organization that's going to attract and retain the type of talent that cannabis so desperately needs. So that's why we thought it would be good to get together. That's what's bringing us together today. Jason, do you mind flipping the slide there for me?
I'll be your Vanna White if you want.
I love it.
There we go.
Yeah, I just want to tell you a little bit about this team and the background of kind of who we are and the work that we're doing every day. There is, I see, Sam, that you have to leave early. We are going to have a recording of the webinar for sure. And so if you just ping us, we can send that to you. So FlowerHire Senior Advisors, we are this retained search division of FlowerHire. We focus on the most challenging and strategic C-suite and board level searches for national cannabis operators. Ours is a high-touch, white glove service. It's a model that we have developed over the past several years as the industry has really evolved. And we're proud to say that we've made more C-suite placements as a firm than anyone else in the space. We also have our HR advisory practice, which Jason heads up. That's also a consultative model where we're really able to offer comprehensive HR strategy, compensation audits, organizational design, and really a whole range of customized services for scaling cannabis operators. So really, that's really just a little bit about kind of who we are and what brings us here. Next slide, Jason, is just our pretty mugs. My name is KMesh Meshkov. People call me KMesh. I invite you to do the same. I am a partner and I work under our managing partner, Brian Fitzgerald, in the senior advisors practice. And I am joined very happily by Jason Desentz. Jason has 20 years of experience leading HR and talent function and human capital for publicly traded companies in the US and abroad. And he has 3 years in cannabis, served as chief people officer for two different Michigan-based operators. And he has implemented stock compensation programs in both of those spheres. So at this point, I'm going to hand it over to Jason. And like I said, Jason is incredibly knowledgeable and has a lot to say. So we're just going to we call this in FlowerHire language, blurt, we're just going to blurt right at him. So when you have a question, put it in the chat. I will go ahead and blurt it out. And we'll just keep interrupting him until he can't stand it anymore.
Yeah, no worries. Thanks, Karen, and welcome everybody. I will be going through quite a bit of topics today, and I think it's important. Obviously, feel free to write down some what I always call good golden nuggets. And if we have a question from you guys, this is what this is for, right? This is definitely interactive. But let's talk about what we're going to learn today. So a couple of things we're going to learn. One is I'm going to talk about just the basics of compensation philosophy and practices, because that does lead into the stock and equity as part of that compensation package. We're going to talk about why companies offer stock to employees and what's its main purpose, right? Why do we even do this? We're going to get into then some terminology in the beginning of what, some stock terminology that I feel that it's important to know. There's so much out there. It confuses people, confused me when I first got into learning about it. I'm going to give you some simple terms and simple definitions. I think that'll be very helpful for you all. And that's something you can use going forward. I'm also going to talk about really the foundational base for the two most common stock stocks provided in cannabis. And one is our options, stock options. The other one is restricted stock units, or RSUs, as you'll hear me say today. We'll get more into detail. And then finally, we're going to come out of here. Let me see, click here. There we go. Finally, we're going to come out and just one little piece that everyone always forgets about, but I want to make mention, is the tax side of stocks. And what does that mean to you? I'm going to go into a little bit about that because I think it's a very confusing topic for not only companies, but also employees who receive it because they just don't understand it. And I want to explain how that works for you all. So let's start. And Karen and I spent some time talking about this. Don't be an emperor's new clothes person. What the hell does that even mean, Jason? You know what? Too many people walk around and think they know about stock. I've been at companies, I've even seen owners that think they know about stock. It's okay. Most people don't know about stock. Even when I first got it, I just looked around and I thought, well, okay, I'll try to Google it and see if I can learn it on my own, because I didn't want to feel stupid because you became an executive, or now you're actually an owner of the company as you think about stock. Don't walk around pretending to know about it. Even if you think you know all about stocks, ask again just to affirm that your knowledge is correct. It's okay. Look it up. Or this is my favorite. Don't be afraid to ask HR. Hopefully they're cool like me and Karen, and we're happy to talk to you. Or guess what? Ask another fellow colleague, because if they get it, they'll be happy to probably tell you all about it. So I wanted to start off with this a little bit to say, it's okay. We all are here. We all didn't know about it if you just got it or trying to learn about it. Everyone started off like not knowing. So it's okay. So with that being said, I'm going to start with this and then I'm going to end with this. And as we get going, I want to give you some questions that I think you can take away as an employee to ask about the stocks when offered to you. So don't be afraid to ask questions like, how many shares will I be granted? A lot of times some companies will say, well, it's a percent. Well, a percent of what? You need to know what that whole percentage is. So that way you can, and then ask them the follow-up. How does that translate into a stock? What is the calculation to turn that percentage into an actual stock number? So that's something you're going to want to ask. You want to know what kind of stock it is. Just because you get stock doesn't necessarily mean it's the right stock. The two most common are options and RSUs. We're going to talk about that, but you need to understand which ones you're being offered. Next is, what is the price per share based on the grant date? So when you get that stock, we're going to get into detail on this, so don't worry. What does that mean? What if I got 1,000 shares? Well, what's the price of that 1,000 shares? You take that 1,000 times that price, that's the economic or value of that stock to you. We're going to show you some calculations. Don't worry. What is the vesting schedule? What the hell is a vesting schedule, Jason? Well, vesting schedule is, not all stock is when you get it, you can cash it. Let's just say that. So a lot of it is time vested, or it's what's called cliff vesting. I'm going to go into those two things for you to understand, because it just as much as I'm getting stock, but when, and that's what vesting is going to tell you. Next is, what percentage of the company's stock, I kind of covered this one already, I jumped the gun, do the options RSU represent and make up? And what if they say you're going to get 1%, but they gave out thousands of shares, and what that tends to do is become dilutive, meaning you really aren't getting, you're not getting as much money or as many stock options if they use the number than you think you're getting. And then finally, what happens to my stock if the company's acquired? Cannabis, it's volatile, right? I mean, I've been at two different companies now. One was acquired, and that's a great thing actually. But what does that mean for you? Do I forfeit my shares if they have invested, meaning time-based? Or do they automatically what's called accelerate, meaning I get them right away based on the sale? These are simple questions you should be asking as an employee. Karen.
Okay, quick blurticle here. This is a screenshot opportunity. For those of you who are candidates, I would screenshot this, because when you are in those negotiations, and as we know, being inside these negotiations, they can move quickly. This is just something you want to have on hand. And have it at the ready to ask these questions for clarity from the team. Okay, back to you.
No, thank you. And don't worry, we're going to cover all these today. And actually, I end on this slide. So
okay.
Good, so now let's talk about comp philosophy real quick. As you think about comp philosophy, what are the main components, and why do we even need to talk about this? Well, basic comp philosophy is designed to guide paid decisions and encourage discretionary effort to the employees. If I put together the right pay package, you'll want to stay. You'll be retained, and you'll actually be, a better off engaged employee. Well, let's really talk about, there's a lot of different things in a comp package, but let's talk about the basics that all of us will get or receive And the first starts with base pay, right? That's just your annual pay per day. Everyone knows what base pay. But one thing to know in cannabis is whether or not what's the market value, meaning, cannabis comp is moving all the time. It hasn't, in my opinion, solidified yet. It's close, and because you're trying to compare it to other industries that are similar, but I haven't found a very similar industry yet in cannabis. I'm sorry, I haven't. We are unique, which is great, but we also need to start getting more data. Most comp packages, though, that I've done in the past for, let's say, automotive, manufacturing, healthcare, they use what's called the 50th or 75th percentile. That basically means all the people that they survey, what's the middle, what's the 50th? I should pay my folks based on that role at that range. Most companies, though, in cannabis should really start to move higher up, because I think, in my opinion, that's how you're going to capture people outside the market. Next, bonus. Hopefully you're getting one, because sometimes this is a crapshoot, even in real industry, right? I pray that cannabis folks are getting it, and we use air quotes, right? But this is part of your package. It's designed to reward for success for the short term, what I did in the last 12 months, okay? And it's really something, payout ranges basically. So they'll usually give you a percentage of your base salary as part of your stock. And I'll show you a little quick calculation here and how that can look. And then it's, again, over a 12-month view. It's just a backward look. It's what I did and how I did it. And then there usually is a payout at the end of the year, after the end of the year, in the beginning of the next year, in the first quarter is when you typically get it. And then finally, the last thing of the three components we were talking about today is long-term stock. And that's another component of your pay. And that's what we're talking about today in this webinar. Why do we do long-term stock? Well, it's really a retention tool, and it's an ownership tool as an employee, right? Like, I actually own part of the company. It's super exciting. It's super energetic for you to actually feel like I own the company. And studies have shown you'll tend to work a little harder because you're an actual owner of the company, and it's a great tool. But really, companies also use it mainly for a retention tool. Because it's time-based and the vesting schedule, which we'll get into, it allows the company to know that if you leave, you will have to forfeit the unvested shares, which again, we're going to talk about. And then again, the two main types of stock we're talking about today are options and restricted stock units. So obviously, all that together, your base, your cash bonus, and your stock makes up what they call your total compensation package. So if you hear that term, or total, they like to use a fancy term, total remuneration, which is my favorite. I'm like, try saying that 3 times. But that's something that'll make up the total base. So let's talk about an example here of how this might work. Here's somebody super stoked. They're getting 200 grand a year. Well, obviously, I'm going to show you how calculations work out. First of all, I just told you they make 200 a year. That's their base salary, right? So how do I calculate what their bonus is? Well, in this example, this person gets a 50% of their base salary as a bonus. It's a lot. It's awesome. That means, though, if you take 50% times 200, you're going to get 100 grand. That's the cash value of what that bonus could be equate to. Now, finally, what's my stock worth? Typically, it's a percentage of that same base salary. Not often, I haven't seen it yet in cannabis where it's a number. Sometimes in some companies it's a number, but let's just stick with percentage right now because it's easy. So in this scenario, it's the same as the cash value. So it's another 100 grand. So obviously you take your base salary, you add your cash bonus, and you're going to equal to what is called your total comp. So in this example of what we just talked about, this person actually is eligible for a $400,000 $400,000 eligible total comp package. So make sense? Excellent. So now let's understand stocks for a moment. This is where I think all of you, obviously all of you are here for this point, and I'm going to go into some terminology that I think is super, super important, but I'm going to give you some basics on some of this stuff. So all stock, these terms will apply. Okay. Issue date. Well, what does the issue date mean? That's the date the options or the stock, RSUs, are given to you. And it's usually called a stock grant. Okay, which gets into the next thing. And that's the date by which they'll look at the market value, or have a market value if you're not publicly traded, and say the stock is worth X. So it's worth $1. So you take that dollar and you have that scenario that we just talked about where they get $100,000 worth. So how many shares? 100,000 shares if it's worth $1, right? That's what the issue date means. So that's the date by which they calculate the price in the stock. Grant price is exactly the specific price of that stock. So not only the date, but what was the closing price on that date. That's how they calculate it. Market price, that's just the current stock price as of today. When things start to vest, grant issue price is going to be different per se sometimes than the market price when you sell it. That's why you got to understand that there's a difference between grant price and market price. Market price and grant price are the same on the day you get it, right? Because we went to the market and we got it. Well, when you decide to hold it and maybe it goes up in price, the market price is going to be different than your grant price. We're gonna share some examples on this. I hope it's not too complicated. Vesting date, that's the date when you can get all the stocks available to you. So we're going to talk about different types, like I said, time vested and what's called cliff vesting. But that's the date when, let's say you get 100,000 shares in it, but they might spread over a 3-year period. That's the date you get 100% of all of it able to vested, meaning I can sell it. That's what vesting means. I can sell it. Okay. I'll pause there for a moment, Karen.
Yeah. Any questions? Put them in the chat. Everybody with us so far. This is another good screenshotable one. And I think it was important just to clarify, Jason, the grant price and the market price are the same on the day that the stock is issued to you.
Correct.
Okay. So to me, that's a big kind of takeaway there, to understand that they're the same. And then as time goes on and the market changes, that price is going to fluctuate.
Exactly. And the whole goal of getting stock is that it's higher than the grant price you got it at. And that's how you make more. That's how and we're going to talk about this called wealth creation.
That's the intention.
Yep. Yeah, no, it's good. No, I love it. So some additional terminology that's just for options, and we'll talk about this a little bit. I'll just cover it, but it won't make sense right now. But again, another screenshot to Karen's point. Exercise date. Options will have what's called an exercise date. Once you're issued the stock, there is actually basically a born on label date. Let's put it that way. So it's just like your loaf of bread or a beer you get that's got a born on date, right? You only have a certain period of time to exercise that stock, meaning cash it or buy it, because I'd rather buy it. So if you don't pass that date, then you forfeit the stock. It goes back into the share pool of the company, and then they can redistribute it how they see fit. Why does that matter? Well, I'm going to talk about that, and we're going to get into what's called underwater stocks, when some people have to let it go because the stock drops below that grant price. If the market price is below the grant price, I'm not buying it at a higher level when I can go out to the market and get it at a lower level. Therefore, you'll let your stocks expire. There's really no benefit to you. Expiration date, and that's also the date by which it passes. Exercise date's date you get it. Expiration date's when you have time to actually sell it. Why do companies put long-term stock plans in place in the first place? What's the whole purpose of it? Well, the reason why they do it is it's really designed to reflect a variety of different objectives. One, value creation. It creates value with the employees of why they're there, and more of an incentive to stay there. It's performance driven. So just like your bonus is performance driven, companies should look at your past performance, and just because you get 50% in stock doesn't mean it's guaranteed 50%. If you did really bad, it's discretionary, just like your bonus. The company can take less away and not give you the full grant. I mean, just because your performance, it should be performance driven. It should also be aligned to the strategy. This is more for the company folks out there. You should have your stock and your bonus plan, quite frankly, aligned to your business objectives, and everyone has cascaded those down, because otherwise you're just giving it, might as well put it in base salary. What's the point? The whole point of incentive programs like cash bonus and stock is it's performance based. We're trying to put that carrot out in front of people to work harder, to be better, to think differently, to be creative. Also competitive pay opportunities. It's a way for companies to differentiate themselves from their peers. They might offer more RSUs versus options, and we'll talk about that. Obviously, like I said before, it's really a retention tool, folks, for the companies and you, and it's very, very smart. This is why it exists for the most part, I'll be honest. And then it's to motivate behaviors towards these objectives. A few other points: emphasize simplicity, ensure clear line of sight between actions and rewards. Again, if I've aligned my incentive pay to what our business objective is, that's how companies succeed. And then it's a higher risk profile and greater leverage than an annual incentive plan, and for more senior executives, meaning as you get up in the ranks, sometimes your pay shifts to be more equity and less comp. And there's a reason for that. It's to drive those executives to take risk and to make sure that they are profitable at the end of the day, because it's up to them to help the shareholder value.
Okay.
Karen.
Jason, I'm gonna blurt because we have a question and
Great.
tell me, and I'll read it and then you tell me whether now's a good time or whether we should hold. So the question is, I thought stocks were more like a fixed salary versus a bonus. From my
No.
understanding, if you tell someone they have 10% equity in the company, that isn't typically going to go down, even if the person is underperforming. Am I wrong in thinking this?
Well, if that's a great question. If somebody just arbitrarily gives you 10% of the company coming in, like those are called A shares, meaning there's no vesting behind it. Yeah, you're right. You own 10% of the company. That happens with some startups, but it doesn't happen as companies progress. No one does that going forward. There is always you want to shift out of percent of company and you want to turn to more actual stock numbers. You don't want to use percent. A lot of cannabis companies, and even including myself, when I got percentage of the company or certain 0.0 whatever of the company. Yes, you're right. If you're given a certain percentage, you're right. It doesn't change, but it's a one time, right? What I'm talking about here is it's an annual cycle, just like your bonus is. Once a company sets up a stock program, it's an annual cycle, and you'll get it every year. And I'm going to show examples of that. But that's a good question.
Yeah. Okay. Let's keep going.
Okay, sweet.
Yeah.
So again, there's a need. Why do we need to pay for performance culture? Well, that's the whole point of it. It's to drive the behaviors and to drive the right things to do. And the way to do that is making sure your vision, mission, values are all set up, and then those lead into your business objectives and goals, which then should cascade all the way down from the department to the individual. And oh, by the way, they better be metric driven, because how do you know you succeeded, right? So this is just a slide to share that this is why it's important. And what do companies do and evaluate? I'm going to give you a little example. This is a 5x5 scale. So, and it's just in words. And these are how some companies will evaluate you. First of all, they want to make sure you hit the results. So once you hit your results, you'll get evaluated 1 through 5. But guess what? The other half is how you did it. Did you have dead bodies along the way to succeed in your goals? You know, a lot of companies should be adopting this. This is for the employers, because in my opinion, this is the best way to retain your talent, because you know they're going to drive the right behaviors and values of your organization while hitting the results that you're looking for. And this is how companies should be evaluating their talent. And you can see I have some quotes here like marginal, bubble, A player. Just as much as everyone wants to talk about high potential, you should be talking about your marginal talent. Because you know what happens, you need to have a plan for that. Coach them up or coach them out is what we used to say. But that's important because they do affect the other players on the team. So here are the two types we just talked about: restricted stock units or RSUs and stock options. Okay, so time vested equity vehicles are full value awards that are earned, that are based on a passage of time. Restricted stock means you get the stock after a certain period of time. Options are you get an option to purchase it at a certain price. That's the difference. I get something no matter what. The other one is I have to buy it. Okay. So equity, which is what the options are, awards that value equity to appreciation of the stock price. This is a basically high risk, high reward scenario. Companies used to do this more in non-traditional or non-cannabis, but most SEC publicly traded companies are getting away from options because of the bigger boom or bust, and they're better leverage in an RSU because it's a better balance between the company still being able to retain you, but the employee feeling like they're still getting value, and I'll explain why. So these are the two most common. Here's the pros and cons. Another screenshot here if I were you. I'm not going to go through each of these, but just a couple of points here. Again, restricted stock will serve still as a strong retention tool for executives and anyone who gets it. It mirrors share ownership. Both of them do, right? However, it offers executive a chance to have a skin in the game, but also be guaranteed something, right? If I get the stock at $10 and it drops to $8, I still get the stock, but it's at the $8. So my value went down price-wise, right? You can do the math. But if it's an option, I'm not going to buy it at $8 when the only promise is that you can only buy it at 10 with the option. So you see what I mean? So at least you get something with the RSU, but some of the cons with the RSUs is that it can go down, right? But in my opinion, hopefully you don't end up like me in one publicly traded company where it went all the way, it was up to 25 and then it went down to $8. That was a really That was a bad year. But at the end of the day, or at least it's some of the cons for an employer, not the employee, is a lot of companies feel like it doesn't have that much of a hook, as they call it, in the retention side of people, because they're still giving out the stock. Some cannabis companies like options because it doesn't really cost them anything. You have to buy them. Whereas the RSUs means no matter what, they have to give them to you. Makes sense. So the grants, and then obviously the downside is what's called underwater for stock options. We'll cover that in a minute, but these are some of the areas, pros and cons for both. So remember that leverage I talked to you about for both employer and employee. So obviously most cannabis company in the early stages, this is all they did, options. And it made sense. It didn't cost the company anything. They just distributed out, and they didn't have to pay you for it, or you didn't have, if it exercised, you couldn't sell it. But the markets are fine with it. It's difficult to implement in private companies because you can't sell it, even though you got an option to buy or an RSU. Well, if I can't trade it, I can't sell it. Yeah. So some folks get a little perturbed or upset by that, and it makes sense. Some then started moving to what's called the hybrid model, which is a mix of RSUs and options. Companies can do that. If you're not comfortable going from right to options to RSUs, maybe try the mix where you give employees a little taste of both. It does meet all third-party regulatory stuff. So a lot of folks think that doesn't, but it really does. I've done it. It actually works. You start to go down that less leverage as an employee route. Remember, I told you that, but it requires selecting really strong measures because, again, you start to think about that performance mix as you move forward. And then finally, RSUs, right? Going 100%. It's the highest leverage for both the company and participants, in my opinion. The only reason I say that is because the employee will feel better because they're getting something no matter what. I've been head of HR and I've had people come in my office saying, my stock's underwater. Why the hell am I here? You know what I mean? I don't see the value anymore. Whereas an RSU, they're like, okay, well, at least I'm going to make, 100 grand versus 200 grand, but at least I'm getting something. There is something to be said about that. And there is limited downsides because of that. And that's really the three main options that a lot of companies in cannabis can do. So I'm going to pause here for questions. Karen and I put a couple of questions. It's not over. Just wanted to pause for a minute.
Oh yeah, this is a good time for questions too, Jay, because it's 4:30. So we're halfway through. Good time to take a breather. I don't see any questions in the chat, but that doesn't mean there aren't any questions. If anybody has anything that's come up, I'm glad, Jason, that you covered the difference. Like for me, seeing the hybrid option is very helpful. So are there cannabis companies, Jason, that you've seen doing those hybrid options?
No, when I've given advice on the advisory side, I always give that as an option because it's something that I think people are afraid to jump, but I want them to put their toe in the water. So I give them the hybrid option. It's not that hard to do. It sometimes can be complex for the lawyers. They don't like it, but in my opinion, I think it's at least a step in the right direction.
Yeah. And certainly, to the point of our provocative title, right? It sounds like the reason that folks are kind of using this, oh, my stock's it's worthless. It didn't is really kind of symptomatic of the nature of options, right? That in markets like these, you have folks feeling that sentiment, right?
And you know what? I'm sure someone out there says, BS, Jason, options are great. I made a ton of money. More power to you. I've been doing this for over 20 plus years, both industry and not. And I'm telling you, folks, options are 9 times out of 10 are going to be underwater when it's time to exercise. And I've been burned, and I could give you tons of my friends' numbers. They've also been burned, and it's not in the low area. It's like hundreds of thousands of dollars. So at least with RSUs, you come away with something. And I feel like the employee feels better. And I know that it's a hard pill to swallow for a company because now they have to guarantee that something's going to be out, whether or not it's the same value as what's different. But yeah, but it's highly recommended. So
we have another question from James Kahn from Holistic. Hey, James.
Hey, James.
I see a lot of private cannabis companies give out stock. Given what you just mentioned, how are employees supposed to cash out?
There's a legal way technically, but I'm not going to get into that. And that's usually you have to put some kind of filing together, but it's not an actual trade. You can't cash out until, and again, we're going to talk to the tax side of it. You won't get hit with taxes until it becomes imputed income. That means you cashed it out, right? So that's the hard part about being private. And, there's the glory of, oh, you got ownership. That's great. Well, it has to mean something eventually, right? And what you hope for is either a sale, then there will be a cash out. And that usually comes to all the stockholders. They'll get some kind of, either what will happen is they'll give you stock in the new company, or they will actually give you a cash out. Or you can go into you can get a lawyer and you get their lawyers, and then you can legally sell it back to the company for a value. But that's, I have never seen that done in my career, but I know it has happened. I just haven't seen it done in my career. So it usually has to be tradable. So makes sense. That was a great question. Thank you.
Another great question. Okay, good. I think let's keep moving.
All right. Options. Are they worth the risk? I think you can, I think you kind of hear where I'm headed, but you know, it's not bad. I'm not saying it's bad, because I don't want people to think out there it's all bad, because yeah, have people made a lot of money? Absolutely. It's just, you know, you have to make that judge. You have to look at the performance of the company. You have to look at the executives that are working at the company, or if you are an executive, you have the leverage to pull to make it, you know, more money. What are you doing that's, you know, compliant? I always say that, to make this more profitable. So this is going to be a little bit, but I want to give you an example. How does it work? So let's say this year in January, you were issued some stock. You were issued 1,000 shares. Okay. But with that 1,000 shares, it was issued at a $10 stock price. Okay. You must sell it 10 years after. So 2032, that's the expiration date. So you can see at the bottom here, or it says expiration date, January 20. That means that 1,000 shares at $10, if I don't buy it within that 10-year cycle, it becomes forfeit. Okay, it goes back. So vesting, however, meaning I don't get the full value of it until 3 years later, till 2025. So even though I got it in 2022, I can't sell it until 3 years later. Well, why is it 3 years later? Well, that's the hook, folks. That's what the retention tool is. If you stick around, you'll get that money. But if you leave, you forfeit. That's it. It'll never be free unless you're coming in early. Like the earlier question, I got a percentage of the company. You must have got it in what's called A shares, meaning there's no vesting schedule with it. That's a great thing. If you can get that, more power to you. So as we talk through this, but let's say then in 3 years, here's where it can potentially pay off. I use Valentine's Day because it makes my heart go good when the stock price goes up. So let's say on Valentine's Day, that stock price is no longer $10 because that's the date. That's the price you could buy it for. It's $20. Okay. You may think, wow, I get $20,000. Hold on a minute. So you have to buy it. You don't just get those shares. Remember, option means I have the option to purchase at a set price on said grant date. Okay. So let's look at this little table here. So it says, I got it for $10 on 1/1/22. I got 1,000 shares at that. So how much is that value? Well, you take 1,000 times 10, you get $10,000. Pretty cool, right? Well, now in 2025, you're like, sweet, it went up to $10. Wow, we're making it double. That's awesome. So it's worth 20. It is worth 20, but you have to still purchase that original 10. So it's really, you only get 10, your profit, your imputed income would be 10,000 because you still have to buy those options. Now, do I have to cut a check, Jason? No. If you're employed, though, a lot of times your employer will have what they call it, you can sell to cover, meaning you can sell, say you tell the broker, hey, sell enough to buy them, and then I want the proceeds left. So that's what you can do. Or if you want all 1,000 shares, by the way, you can cut them a check for 10 grand and they'll give you all of them. So that's what you can do. So remember, original grant date was that on 1/1/22, and the value of it was 10,000 based on that calculation. 3 years later, it went up to 20,000. And then your final overall profit is really just 10,000. And it looks a little deceiving, but remember, you still have to buy it. Okay. This is the difference between options. Now, Jason, you talked about this underwater option. Can you just give me an example of that? Sure. So I talked about the underwater option. In this example, instead, you still got the same stock. It's $10 on the grant date, but let's say instead of trading at $20, it's trading at $8. For obvious reasons, you don't want to exercise, meaning I want to sell, or I want to purchase rather, my options. You wait. Now remember, if you wait past that 10 years, you forfeit. But it's called underwater. You don't want to sell, because why would I sell it for $10? That's the promise price, versus what I can go out and call my broker and say, hey, go buy at the $8 a share. It's cheaper. So in this example, here you go. So obviously you got it for $10. It's now worth 3 years later. Same example, $8 instead of 20. If you do the math, it's underwater. It's basically worthless. So there's no point in you actually buying it. So I'll pause there for questions.
I have a dumb question.
Never a dumb question, Karen.
All right, I'm sorry. I shouldn't, I feel I put my foot in it there. I'm sorry. I have a question, Jason. The exercise date and the excise date, why are they different again?
The
How are they
exercise date and the issue date. So the exercise date and the expiration date is what you're confusing.
That's what I'm confused about. Why are they,
So the
and why are
exercise
they
date-
3 years apart and
The
1 month?
exercise date, just think, instead of using the, yeah, you know what, this is why I love lawyers. They should have just changed the term. Why do they call it that? Instead of exercise date, they should have said sell date. I don't know why they don't call it sell date.
Sell date,
Or
okay.
buy date. Well, if it's an
Maybe
option,
just sell
maybe
date.
that's why, because in options, you got to buy it. So it's not really a sell, right? It's like a buy sell. But yeah, that's the difference. Think of it this way. You're going to purchase that stock with the promised price, right? Which is your grant price. So, and then the exercise just means I have 10 years or a right to buy it within 10 years at that $10 price.
Gotcha.
Does that
Okay.
make sense?
Yes. And then the expiration date is 7 years later.
No, in this example, they got it this year in 2022. It's usually that's a great question. What is most average exercise dates? It's usually 7 to 10 years. So every year you'll get a stock, just add on 10 years after that. And that's how long you get it. You'll get another one in 2023. Guess what? In 2033 is when it expires. You get one in 2024. 2034 is when it expires. So every, whatever the 10-year they have on the expiration date is what the stock will be from its duration of time. You can sell it.
Cool. Thank you.
Yeah, no problem.
Another question we have is there a way to write off loss associated with underwater stock options? Good question.
That is a good question, and I don't want to give you the wrong answer. I would tell you, sorry, ask your tax advisor. It depends upon your tax situation, in my opinion. I don't really want to give you a false answer, so I hate to do this, but I would tell you to defer to your tax advisor on that one. I believe there is, but I don't want to say that one way or the other.
Okay, moving right along.
Moving right along, as they said. Okay. So now let's talk about restricted. This is my faves, as I've said before. There are two types though. I'm going to confuse you, okay? But hang on, stay with me. Cliff vesting versus what's called time vesting. What is cliff vesting, Jason? Well, cliff vesting is basically lump sum. You don't get it every year part of the original grant. So a lot of times they'll split it over multi-year. So they'll give you some in year 1, some in year 2, some in year 3 of that original grant. So let's say those 1,000 shares, they'll split it up between 3 years, right? And you'll get like 333 this year, 333 next year, 333 the following year. And then you're fully vested, meaning I fully sell all my 1,000 shares, or I have access to sell them, right? Cliff vesting is, a lot of times I see this. I don't encourage employers to do this, but I understand why, because they don't have the funds to issue out that stock. So a lot of times employers will move out like a 3 or 4 year. Don't ever do a 4 year, in my opinion. That's way too long. That's like an eon in cannabis. Come on, 1 year, 7 year dog years, right? So I think anything above a 3 years is unfavorable to the employee, in my opinion. Employers, don't do it. Don't be that greedy. It's not worth it. You'll better retain your employees. Your competitors are already doing that. So do 3 years. Let's talk about time vesting. What's the difference? It's called graded or time vesting. You may have heard the word graded, but it's the same thing. So here's how that works. So instead of waiting 3 years to get that 1,000 shares, you get a piece of it, like I just said. So I get 1,000 shares this year. Come 2023, 333 shares will vest, meaning I get those are mine. I can decide. Now there are issues. I get whatever the value is. If it's $8, $10, $20, doesn't matter. Do the math. Times 333, because that's a third of 1,000, right? Just doing the math in my head. And then come 2024, another third will vest. And then the full value of that 1,000 of that original grant will vest in 2025. Now, why did I show you this little step? Because remember, these are made to be given to you every year. If your company is good, you'll get these every year. So guess what year in this example is your wealth year, as I call it? 2025. Because why? Because you're getting the rest of your 2022 grant, you're getting your second tranche of the 2023 grant, and you're getting the first tranche of the 2024 grant. This is why retention at any company this is where you can make your wealth. If you stick around long enough and you get a stock every year, it could be very lucrative. You're going to start getting more and more ownership in the company based on the shares. So that's the difference. Cliff vesting, I'd have to wait. I get the grant in 2022. I wouldn't get the full shares till 2025. If I did the 2023 grant, same thing, 3 years later. So I encourage companies to do the time vesting because then the employee still feels like they're getting something, right? If you have to wait 3 years, 3 years is still like 4 years is way in eternity. 3 years is still a long time in cannabis.
It is.
So yeah, and here's the example I gave, a third, and a third. And that just talks about a lot of first of all, boards have to approve the issuing of stock every year. It's comp committee. It's something boards do. It's not just the owner or investors doing it. There has to be a board resolution to give out stock every year to management. And there is a management pool, which I'll talk about because that's important for you employers out there. You need to make sure you have a properly funded management pool of stock, because if your stock's really low and you only have that many shares to give out, well, you're going to do the math and you may have 30 people that are eligible in your company. You're not going to have enough stock to give out. We're going to talk about that.
Okay.
So remember I talked about stock and wealth creation and, well, Jason, what does that look like? I don't understand. Okay. Well, in this example, this person isn't making as much in the first example of comp, but let's start here. So their base pays 200. Their long-term incentive stock is 20%. You just take the percentage of 200 and the value of whatever, you can then convert it into shares. But every year they'll get $40,000 worth of stock every year. That's kind of the baseline here. So this looks eye-popping, but I'll walk you through it, I promise. So
I definitely need a screenshot of this one, Jason.
Yes, I would say this is another screenshot. Now, this is an example, folks. What I'm trying to show here is how the stock on the time vesting can show you the real value. Okay. So remember that 2022 grant I just showed you? I'll go back here.
Yeah.
Here it is in this example. But let's say the stock's $2 a share. Okay. The stock value I just told you is 40,000, right? Every year they get 20% of their base salary. Now that assumes their base salary doesn't change. Now every year you're supposed to be getting merit and all that stuff. So technically your percentage will increase every year, right? If you work for a really great company that gives you merit. Always check that out. Always great question to ask. How often is your stock or your bonus paid out in the last 3 years, and have you given merit out in the last 3 years? It's another thing that you always want to ask.
Oh, we should add that to the list of questions.
Well, yeah, I'll add it at the end. Remind me.
That's a good one. Those are good ones.
So let's talk about this example. So if the stock price were $2 in 2022 and they're eligible for $40,000, just do the math. 20%, that's 20,000 shares, right? So how do I divide over the 3 years? Well, here's the math for you. It's a third, a third, and a third. And those are the number of shares you'll get every year. Following year, you get another tranche of stock, but this time it's at $5. So naturally the share prices or the shares are going to go down because the math is higher. That's a good thing. So when the stock's low, you hope to get in early when it's really low and you get more shares because it's a percentage, but naturally your company should be progressing, right? In that. And it looks like it's slower, but then you could start to see that wealth creation. Remember what I said by 2025, that's that gravy year. By that year, look at how many shares you have. Oops, sorry. Look at how many shares you have eligible for yourself. 11,000. That's a lot. Okay. And if you did 11,000 at $10, you'll see the total value there at the end of the day here. So as you go along, all the share price, you can see here at $10, all those shares, I would have the value creation of 337,000. But let's say your stock went up to, you didn't sell anything, you kept everything. Let's say the stock's $25, almost $1 million you'd have in total share value. Now, no one's going to, I don't know, people may keep it. I don't know about you, but I need cash. So you're going to sell it from here. You're going to sell it from time to time. It's definitely going to be something you're going to do for sure. Okay. I know this is a little complicated, but this is to show you how that wealth can actually be created. And this is why stock price going up is so freaking important. And I used to create these for executives. We used to call them executive one-pagers because people like to change it and the price. Well, what if it's at 20? What's at 12? What if it's at, and then you can start to see your value of your stock. So I'm going to pause here for questions and I'm going to get it final last thing for tax. So I don't know, Karen, if we have any other questions coming up.
There are none in the chat. If anybody wants to throw any in, this is your time. I think everyone's just taking it all in, Jason. It's a
It's
lot.
a lot. I know. Hopefully I'm doing a decent job in covering and not going too fast, but I'm trying to cover quite a bit in a short period of time. I mean, normally,
That last slide gave me the good feels. I really,
well, look, I love my little guy. He's
all of
like,
our executives. I want that for all of our executives in cannabis.
yeah, this is what I share this. I give these calculations out to my executives, show them why stock is actually a good thing, not a bad thing. But how you get that stock or your options, that's what you have to be asking. Not the total value of it at the end, but like, how can I influence that? All right. Well, one quick thing. I'm going to give you a quick example of stock distribution. And this is why employers out there, this is why it's important for you to make sure your management pool is fully funded. Because if the stock price is lower, remember that example, you're going to be giving out a lot of shares at a time. Now, as the stock goes up, the shares go, number of shares go down, just pure calculation. This is why I've worked with a lot of companies. Everyone says, what's the magic number? It depends. And it depends by how many people are eligible for the program. If you're young and you don't have that many executives, I think 500,000 shares is fine. Typically, I tell people $1 million to $2 million. Always have that set aside for your management pool. And it should last you, in theory, 2 to 3 years. But if you're kicking butt, or you're not kicking butt, your stock stays low, that's not going to last you long. But if you're kicking butt, you're going to probably have to fund it, or it'll stay a while. But if your stock isn't going up, you're going to lose. You're going to have to refill it. And usually it's supposed to last 2 to 3 years. And the board has to approve those. Again, you have to have a board resolution in the books, making sure that those shares are set aside for management and who's eligible. Okay. So note, depending upon the percentage of the award, this just says it may or may not be too low. And that's something that companies need to pay attention to. And also employees, right? Like, holy mackerel, it's crazy. So let's finalize with taxes. What does that mean? I'm not a tax advisor, so disclosure right now, this is not, I still think you should talk to a tax advisor, but I'm just going to talk about how you can sell your stock to cover your taxes, or how it's typically done in most services that provide to help you sell it. Okay. Some companies will withhold it. And it's usually if you're an employee. If you are a single entity or someone who isn't employed by the company, but is an investor, you have your own tax person, you have to figure that out. But this is an example of an employee who's still employed and how it's typically done. So some companies will deduct it. And I'm gonna show you in the next slide a little calculations, but some will tell you, we're gonna give you the full amount, and you have to deal with it with your IRS. Hopefully your company is set up with a broker of some kind that can trade it for you and can also deduct the taxes or sell shares. Just like I said, sell shares to buy. You can also sell shares to cover taxes. And that's a good thing. And most are defaulted to sell shares to cover taxes. And I'm going to give you this example right now.
So wait, real quick before you jump in, Jason,
yeah.
What you're saying is that if you have stock, if you're an employee and you have stock in your company, you're going to work with both your own tax accountant and potentially someone at your company who can advise you.
It's never, I would say at the end, all of us should be working with tax account or TurboTax or some form of help, right? That's different, set aside. Think of it this way. This is like a bonus. It's imputed income. Right. You have to pay taxes on your income, right? Your salary, your cash bonus, no different than stock. So the question is how is that taken out? If your bonus is you're giving it in your paycheck, the company still takes out the taxes, pays FICA, pays all that stuff.
Right.
So this is just how are taxes taken out for my stock. It's not going to be done necessarily through your payroll. What's going to happen is you're going to have to, if you don't have the cash to write them a check to cover the taxes, you have to, most are set up to sell some of your shares. You don't get the full shares, but it's going to pay your taxes and you're not going to have to worry. But it'll be part of your total imputed income statement at the end of the year, right? Your W-2. Yeah. It'll be part of your W-2, and that could put you in a new tax bracket, all that kind of fun stuff. But it shouldn't be too bad. But in this example, let's say you got 100 shares. I know I'm using low. Stock price is 50. It's way high at the time, so it's worth $5,000. Sample tax withholding at this rate, where I'm just going to use a 35% tax rate. I take that $5,000 times 0.35. I owe this much in taxes, $1,750 on that $5,000. So I can either write a check for $1,750 and then taxes are covered, or if I don't have the money, which most of us don't, I say, sell some of those shares to cover my taxes. Therefore, I only get 65 vested shares times that $50. Make sense? So I basically, this is a good thing. This is a good thing. You want them to sell your shares to cover taxes if you are not, because I will tell you, if you miss it to choose the option, I had an executive once, and I won't name his name, but he had a stroke of $400,000 check because he thought he chose net shares, meaning sell shares to cover. And he's like, nope, you owe us 400 grand, buddy. And that was a big boo-boo. So, but this will go on your W-2 statement if you work as an employee. Again, this is just an employee perspective. I'm not talking private investor. I'm not talking consultant, anything else different. This is for an employee only. Okay. So that's taxes. I just wanted to touch on that. Again, I'm not a tax advisor, full disclosure here. So this is just guidance, and that's what this is for. And again, this is called netting of shares to cover taxes. That's what this model uses. Okay. Most are set up that way. So recap, I told you I was going to end on this, and Karen should have 2 more questions for me to add.
Yeah.
How many shares will I be granted? Try to get out of the percentage game. I own a 1%, I own 2%. If you own those as A shares, meaning they're all automatically vested, that actually is not a bad thing. That's a really good thing. But 9 times out of 10, that's not going to be all of us. Second question, what kind of stock am I getting? You know now what the difference between an option is and an RSU as part of the equity package. Third, what's the price per share based on the grant date? That should be in the stock grant when you get it. It'll say, we're going to be 1,000 shares, $10 a share is what the value is. It'll be in a legal document. You'll have to sign it. Company will sign it. This is all legal documents. What is the vesting schedule? Remember, cliff vesting, time vesting. I encourage, if you're an employee, you want time vesting and you don't want it more than 3 years. If it's cliff vesting, you still don't want it more than 3 years. Employers, I get why you would do it, because you don't want to give all your shares out at once. But eventually, as you get farther along, you're going to have to start paying the piper. So I encourage you, you're not gaining that much from doing it unless you're really super stretched on your stock. What percentage of the company stock do these options and RSUs make up? We didn't really get into too deep on this, but eventually it's good to ask this question if you can get the answer. This one's a tough one because people, that cap table, which is what the total shares that the company has, you'll have private investors, you'll have employees, and what you want to know is, man, I have 300,000 shares. I'm living the life. Well, okay. Or if I have what does that really mean as far as percentage ownership of the company? Because the more people that own stock, the more what's called diluted your stock gets as far as ownership.
But that's also, Jason, why people get into that language that the gentleman was talking about before, like, oh, I own 10% of the company, or I own 5% of the company.
Oh, like I said, if you can get it, that's great, because he's right. Whatever way the company goes up or down, he'll always get a percentage of that or own a percentage of that. Correct. So, and then we didn't get into too deep on this, but what happens if the company sells? A lot of times it should automatically vest your stock. So if you're doing all that time vesting, it's called accelerated vesting. So it should be accelerated, and hopefully you'll get that stock agreement. Hopefully the language will in there will say something if you leave the company. If you leave the company, typical language will be it forfeits. You forfeit the rest of your vesting, meaning all those other thirds, you automatically give them up. However, if stuff's already vested, that's yours. That's yours. Company can't take that away. So it's all about, what if the company's acquired, and hopefully if it's acquired, all your stock accelerates. It might not. Some companies don't do that, but it's good to ask that question. And there's 2 other ones, right, Karen?
Yeah. What were they, Jason?
Oh, come on. That's funny. All right. Well, let's go to questions from the audience here. What do we got?
Prime time. Yeah.
This is it.
Are people still with us? I hope they are. I'm still with you, Jason. I'm still with you. And I was the one who was like, man, this is a lot of information.
It's good though. Good information.
What was my question? I did want to circle back. Can you flip back in the slides and we'll find those 2 things that I think were really important in the questions?
Let's go.
Just because they were, and if there's anybody hanging on who
was it taxes?
No, it was before taxes.
Stock distribution wasn't this.
Stock distribution.
It was this slide, wasn't it?
It was this slide, and it was like,
it's the wealth creation. Hopefully, I mean, I trust me. I played this out a little bit because I want you to see how exciting it could be.
Stephanie says merit.
Yeah, what about merit? Like
Stephanie,
what,
say more. We need more.
if merit
think
is just your, merit
the
is just the
question-
process every year by which your salary should increase based on market value. Hopefully your HR team is doing market assessments on an annual basis, and on the typical percentage that markets have kind of gone in the last 38 years is roughly 3%. So you can take your salary times 1.03, and that's what your new salary should be on average. Okay. Again, performance-based. Companies should be doing things differently. High performers should be getting more per se.
Yes, right. How often have bonuses been paid out in the last 3 years?
That's
Yeah.
it. Yeah. You want to ask that question. How often has bonus been paid out in the 3 years? And also how often, that's why she said merit. How often has merit been given in the last 3 years as well? And the reason why you want to ask that, that
Thank you,
shows
Stephanie.
that the company has cash, in my opinion, that they're giving their money to their employees. Because the worst thing that can happen is and it's going to happen to some companies, because right now we're in a tough macroeconomic times. So it happens. Unfortunately, I've been a part of companies many times that have done it, but it's not recommended because you lose employee engagement.
Awesome. I think we are at time, and I think folks are probably trying to get out of Dodge. But before folks leave, I just want to thank everyone for coming. Jason, that was amazing. So much incredible information. We will try to get recordings and screenshots to folks who maybe had to jump out early. We are here. If you have more questions, if you'd like to talk with Jason and I, either about a package and offer that you've been given, and would like to spend some time with us going over the details of that and really kind of parsing through it, happy to do that. We're also here for anyone who from cannabis companies. I know there were a couple folks in the audience to just talk about this stuff with all of you and parse it out. This is challenging and complex, but for us, very exciting and what we do all day. So thank you so much for joining, and looking forward to talking to you all more about this topic.
Thanks, everybody.
And we're out.
We're out.
Telemundo. That was great.
Thanks. You did too. You did awesome.
Thank you. I tried. It was really fun.
It was a great tag team.
Yeah, it was good. That was really fun. Yay,
See?
us.
Stocks aren't that hard.
I learned a lot, man. A lot. I didn't know that A shares had no vesting.
No, they don't. That means you automatically get them. There's also B shares, which is a different type of investing. I won't get there. There's so many other things that I know that I haven't even shared that are just not worth talking about. It's more for owners and or more established companies. So
Yeah.
we didn't get on the PSUs, which are performance shared units, or like I said, return on invested capital, or ROIC.
Yeah, but I think that takeaway slide was really great. Of course, we do have to deal with the issue of, like, I realized as soon as I said it, like, yeah, we're sending you a recording.
No, I'm okay with it. At the end of the day, we're recording it anyways. And
Okay.
I would say whenever we send anything over, disclaimer.
Yeah, I agree. We are not
we need
tax
to have a disclaimer.
professionals. So that's a question of who we ask. What should it
We probably should put some disclaimer. This is not a legal document. Always you should get advice of an attorney, and also a tax advice. This is meant from an opinion-based standpoint. And we have to put a disclaimer in there.
Okay.
Because we could be giving someone go, oh, it's because it's not wrong. It's just, I can guarantee you some lawyer guys, well, that's not technically true. It could be. And it's like, and I know
Right.
it's true. They crack me up a lot. And I did insult the lawyers, but
It's fine. No, I think we did good. And I also think that we did a good job of addressing the provocative title.
Yeah.
Without being, too irreverent, right? I know it was an irreverent title, and Brian was kind of like, oh, I don't know if we want to call these companies stock worthless.
I like it. You know what?
Yeah.
I think Dave puts out a lot of provocative stuff. And I think that's a good thing. It's not.
I think it's important. I think it's important. That's why people tune in, right? And we addressed it without skewering the companies, right? Nobody said, like, all the cannabis stocks are in the shitters because these cannabis companies are run like fools. We didn't say that.
No,
we didn't say anything like that.
We
and
didn't
we
say
wouldn't
that. No,
have.
not at all. We just said, look,
Right?
here's the differences between two of them, and here's something to think about. And
Yeah.
full disclaimer as well. It's like, you have to educate yourself so you understand what the value is, and is it worth. That's why I left the two companies when I was in them. It's like, I saw no more value, and I said, and I was done, quite frankly. I'm like, there's not much more I need to do. Like, you guys are already cranking on it. All right, I'm gonna go on my boat.
Dude, go on a boat. It's a short week. I love it. That was great, Jason. It was so fun working with you. You made me look so smart.
You are smart.
If
Stop.
people think I understand 30%, but it was good. I liked the way I was able to be like the student being like, hey, I have a question. Cause maybe
No,
other people have that same question.
Again, you ask the questions that others always ask. There's a
Right.
lot more there, and people will watch the stuff again and they'll be like, oh, okay, I get it.
Yeah.
Or Google it, which is fine. Go Google it.
No, I'm so glad. I feel like we just created like content that the industry actually needs that nobody else is putting out there. So like,
No one else is gonna put this shit out there. Trust me. All right, Karen, have a good one.
Talk soon.
Yeah.
Bye.
Bye.